why the Fed is losing control. Welcome back, everyone. The financial world is, well, it's incredibly complex, right? But we're going to break it down today. Okay, let's dive right into this explainer. We're going to look at how central banks, and specifically the U.S. Federal Reserve, went from being, relatively straightforward stabilizing forces to suddenly fighting this modern, seemingly impossible economic chaos. So, here's our roadmap for today. First, the unstable era of banking, then the birth of the Fed, the economic brake pedal, the inequality complication, and finally, the Fed versus fiscal policy. We're essentially tracing the history of bank runs, unpacking the Fed's mechanical tools, and then looking at how modern issues like deep inequality and crazy debt are basically breaking those exact tools.
Section 1, the unstable era of banking, a chaotic history. Because to truly grasp why the Fed is struggling so much today, we actually have to go back and understand why central banks were even needed in the first place.
Okay, so starting way back in 1694 with the Bank of England, the history of banking has just been deeply chaotic. The whole idea officially started in Europe, but here in the US, early banking was a massive struggle. You had the First Bank of the United States chartered in 1791, but these early places were pretty compromised. They were regular banks, driven by profit, trying to balance making money for investors while supposedly acting in the best interest of the country. And the political pressure was intense. President Andrew Jackson famously abolished the U.S. Bank in 1836 because he felt it had way too much power. After that, honestly, it was the Wild West. We had all these unregulated regional banks just printing their own depository notes. There was literally no guarantee that one bank down the street would even accept a piece of paper from another bank. So all of this fractured, decentralized chaos finally came to a terrifying head in 1907. There was this massive run on independent, completely over-leveraged banks, and it literally almost brought down the entire financial system. It got so bad that a group of private financiers, led by J.P. Morgan himself, had to actually step in. They had to inject their own personal cash to act as a lender of last resort. And well, relying on private billionaires to bail out the whole system, that kind of proved, once and for all, that we absolutely needed a centralized, formal authority. Which brings us to Section 2, Birth of the Fed, creating a backstop. That harsh realization leads us directly to the formalization of the modern U.S. central bank. At its core, what is a central bank? It's essentially an emergency backstop, an independent regulator of inflation and employment, and the administrator of a functional currency. Today, pretty much every country on Earth has one, basically because they work. They act as a crucial check on economic recklessness. But, and this is super important to remember, when the Federal Reserve was created back in 1913, its original scope was so much narrower. It was really just meant to prevent those catastrophic 1907-style bank runs. How? By simply acting as a safe depository for private banks and lending them money during a panic. That's it. And this brilliantly illustrates how that role exploded over the years. Fast forward to 1977, and the Fed's responsibilities got formalized into what we now call the dual mandate. Now, this is really interesting if you look at other central bank models globally, like the European Central Bank, for example, focuses almost entirely on just inflation. But the US Fed, they are tasked with two massive jobs: keeping inflation in check to stabilize prices and maintaining maximum employment. All right, Section 3, the economic brake pedal, how the Fed works. So how on earth does the Fed actually achieve this massive task of managing an entire nation's economy? Let's pivot from the history side of things and look at the actual mechanics. The Fed's toolkit is actually surprisingly limited. It's not like they can just go out and hire 1 million people to boost employment stats, right? Instead, they rely on this sort of Rube Goldberg machine. See, regular people like you and me, we can't just borrow from the Fed. So step 1, the Fed sets the overnight cash rate. That's the interest rate it pays other banks to park their money with them. Because this rate is totally risk-free, it essentially sets a floor for the whole economy. Then, step 2, private banks adjust their own borrowing and lending rates based on that floor. Step 3, this ripples all the way out to the rest of us, shifting how much businesses and consumers are actually willing to borrow and spend. And finally, step 4, that overall shift in consumer demand starts changing overall prices. Think of it like driving a massive car. Interest rates, they act as the brake pedal. If inflation gets totally out of control, the Fed taps those brakes by raising interest rates. That slows down borrowing, it slows down spending, but, and this is the catch, it also hurts overall economic growth. On the flip side, open market operations, which is when the Fed buys up government bonds, well, those act as the accelerator, pumping cash directly into the system. And the absolute most extreme version of stomping on that accelerator is quantitative easing. In times of massive crisis, like during COVID, for example, the Fed basically bippity-boppity-boops cash into existence. They create money out of thin air to pump huge amounts of liquidity into the market by purchasing government and corporate bonds. This blows up the Fed's balance sheet, flooding the entire market with cash just to keep the economy from totally freezing up.
But right now, there's this fascinating mechanical quirk happening. Because the Fed bought all those low-interest bonds back during COVID and is now paying out super high interest on overnight deposits to fight current inflation, the Fed is technically running at a massive financial loss, literally billions of dollars. Now, mechanically speaking, this doesn't matter at all. The Fed literally prints its own money, so a loss just means they're taking some money out of circulation. But politically? Oh boy. To the average person or, an ambitious politician, this looks like absolute gross mismanagement. Which brings us to Section 4, the inequality complication, breaking the tools. This is where we hit the real friction today. We're looking at the modern complications that are fundamentally breaking the Fed's traditional tools. Now, what's really interesting about this quote, that managing monetary policy is like balancing a stick on your hand, and a very large stick is very hard to balance, is the sheer scale of the problem it represents. If a small stick is manageable, our modern debt load is like trying to balance a giant redwood tree. We are dealing with absolutely unprecedented levels of household, corporate, and government debt. This means that even the tiniest tap on the interest rate brake pedal has massive, dangerous, and sometimes totally unpredictable impacts on anyone holding a lot of debt. Because of this, the Fed is no longer managing a single unified economy. It's crazy, but because of massive inequality, they're actually trying to manage three entirely distinct economies at the exact same time. You've got the wealthy asset economy, the indebted regular economy, and the continuously expanding government economy. Just look at this stark divide. When the Fed pumps money in during quantitative easing, a huge chunk of it inevitably settles with wealthy households. They use all that extra cash to buy up assets, stocks, real estate, which drives those prices straight up. But later, when the Fed wants to fight inflation and hits the brakes by raising rates, those same wealthy households are largely insulated. I mean, they don't really rely on borrowing cost anyway. So instead, the Fed ends up desperately trying to suck money out of the system by aggressively squeezing indebted, regular people who just end up getting absolutely crushed by those high rates. And it actually gets even more complicated than that. There is this incredible ultimate irony in modern monetary policy, pointed out by Nobel Prize-winning economist Joseph Stiglitz. Think about this. If you raise interest rates to fight inflation, you are also raising the cost of commercial real estate mortgages. Suddenly, businesses have way higher rent. And how do they cover that rent? By raising their prices. So the exact tool designed to fight inflation is in some sectors literally creating more inflation. It's a total paradox. All right, Section 5. Fed versus fiscal policy. Slamming the accelerator. This brings us to the final and honestly, perhaps the most volatile climax of this explainer, the current ongoing battle between the central bank and the government itself. Right now, we are witnessing a direct, real-time conflict. On one side, you have the Fed executing monetary policy, basically slamming the brakes to pull money out of the economy and cool off inflation. But on the exact opposite side, you have the government executing fiscal policy, which is essentially slamming the accelerator to the floor. Through massive government spending and massive tax cuts, and to be totally clear, this has been a consistent strategy used by both major political parties over the last few decades, they are actively stimulating the economy at the exact same time the Fed is trying to slow it down. So the crucial point is this. If the government actually wanted to help the Fed fight inflation, they would need to implement contractionary fiscal policy. What does that mean? It means they would need to raise taxes and lower government spending. That would actually pull money out of people's pockets and cool demand evenly across the board. But politicians run on very short election cycles. Nobody wants to be the guy who takes away the punch bowl at the party, right? It's incredibly unpopular, so they just don't do it. Which leads us to an incredibly interesting number, 0. That is the exact amount of actual magic inside the Federal Reserve. Technically speaking, there is nothing the Fed does that a highly disciplined Treasury Department couldn't just do itself, without even needing an independent central bank. The operative word there, however, is disciplined.
Let's move to a real-world example and see how this builds into real, terrifying consequences when that political discipline just vanishes. Just look at Turkey. Over there, the political pressure became too great, and the government essentially forced its central bank to scrap its independence. The politicians absolutely insisted on keeping interest rates super low to spur short-term growth, and they fired any bank leader who dared to push back. And the result? Completely disastrous hyperinflation that the country is still grappling with today. Time and time again, politicians will almost always choose a short-term, immediate economic sugar rush over long-term stability.
And that leaves us here. We have a deeply, deeply fragile balance of power right now. The tools of the past are severely straining under the weight of modern debt and deep economic inequality. We have governments actively fighting against their own central banks. So I'll leave you with this. With governments slamming the accelerator and central banks desperately slamming the brakes, what happens to our economy when the political pressure to scrap the Fed becomes just too much to ignore? It's a huge question, and honestly, it's one that's going to define the next decade of global finance. Thank you so much for diving into this explainer with me today. Stay focused and keep asking those big questions.